Hi everyone, in this video I'm going to talk about a cash flow statement. What is our key unit competence is to be able to prepare financial statements. Our learning objectives are: 1. We shall explain how the estimate of cash flows assists users in evaluation of business performance. 2. Interpret the format and content of the statement of cash flows. And the last one, we shall be able to prepare the statement of cash flows using the two methods. A cash flow statement is a statement of changes in the financial position of a business due to the inflows and outflows of cash. It is more useful for short-term analysis and cash planning of the business. There are two methods of preparing CFS. 1. The direct method, and 2. So let's look at example 1. Given information below on Akagera Business Group Limited, on 1st April 2005, ABG Limited had a cash balance of 10 million francs. It expected cash sales of 5 million francs per month. Credit sales were to be 3.5 per month, and payments would be made in the following month. Monthly rent income was expected to be 1 million. And you continue up to the last one, which talks about monthly raw materials for 5 million. Required, prepare ABG cash flow statement for 3 months. Now let's look at how we're supposed to attempt it. So this is how you're supposed to have posted it. Not forgetting the title, so you write details, another column for April, another one for May, another one for June, since in our question we are being asked to prepare cash flow statement for 3 months. And then from there, having in mind that the cash flow statement comprises of 2 components. 1, your balance brought forward. 2, cash inflows. 3, cash outflows. And lastly, the net cash position. So as it is indicated up there, they gave us a cash balance brought forward of 10 million. So we shall indicate it 10 million in the first month of April. Then we continue. Cash sales, they told us cash sales were to be of 5 million monthly. So we shall write 5M, 5M, 5M in the 3 months. Then they also told us credit sales. Credit sales, we sold goods on credit. That means that is an inflow. Any time of the day, or of the week, or of the month, we shall get back our money. So it's an inflow. And then they told us the amount of money was recorded in the following months. That is the month of May and June, not in the month of April. Then they also gave us monthly rent income of 1 million. So you post 1 million, 1 million, 1 million. As you hear, rent income. So it's an income that you get from the rent. That is an inflow. If it was only rent alone, then it would fall under our cash outflow. Then they also gave us a bank loan from BK. As you hear, it's a loan. So we got a loan. That is an inflow. Money comes in. Of how much? 10 million. That shall record it in the month of April. Then after checking all the information, I think that is for our inflows. Then you're going to sum it up. 10 million plus 5, up to that we come to 26 million. Then below, our cash outflows. We said purchases worth 6 million. When you purchase something, monthly purchases 6 million, 6 million, 6 million. So you're spending money, so money is going out, it's an outflow. Then salary and wages, this is obvious. We are paying our workers 800,000, 800,000, 800,000. Then they also talked about, I think, purchase of raw materials, which is 5 million, 5 million, 5 million. Then interest on loan, monthly interest on loan. So in other words, the loan that we acquired, we're supposed to pay an interest of 100,000. So that is an outcome. So we shall record 100,000, 100,000, 100,000. Then from there, you also do the needful by adding it up. You come to 11,900,000. So how do we get our net cash position for the month of April? We're going to get 26 million minus 11,900,000, and then we come to 14,100,000. So this is our net cash position for the first month. This amount is carried or is brought forward in the next period. That's why you see in the month of May, in the first column, second column, cash balance brought forward is 1400,000. Don't ask yourself where this amount of money came from. It comes from the balance of our inflow. So you continue. Again, here we shall add them up. We come to 23,600,000. Then there we add them up again. Cash outflow 11,900,000. The difference of the two, 23,600 minus 11,900, we come to 11,700,000. We continue to the last month. Again, how do we get our cash balance brought forward? This that we got as our net cash positions, the one that we bring up there. 11,700, you do the same, add them up, which comes to 21,200,000. Add all this to get your cash outflows, which is 11,900,000, to get the difference, and then you come to your final net cash position. I think you all can see I highlighted it green. It's a net surplus. Our inflows are exceeding our outflows in all the 3 months. But there are times where you find in one month your outflows are exceeding the inflows, and in the other month, so it keeps on, keeping on changing. Hope it was understood. Let's continue. So here you're given a question to attempt. Feel free, find time and breathe. Prepare Naomi's cash flow statement for the month of Jan, Feb, March, April. So here you again using direct method, we do the same as we have done up there. We can also give you such a question: transactions January, February, water bills, all that much, and then you're asked to prepare cash flow statement. The following shows the transaction of Dish Enterprises for the month of Jan and Feb. Let's look at another way we can ask cash flow statement. Elijah Advocates and Soft Drink Dealers started business on 1st August 2013 with 50 million francs and a loan of 70 million francs from EcoBank Limited. All the money was kept in the bank. Interest on the loan per year is 16% on a reducing balance basis over a period of 5 years. The following are the projected estimates in London francs for the first 2 years. So there they are. We have the compo items, year 1, year 2, income from sales, fixed costs, and variable costs. So what are we being asked? We are being asked to take cash flow statement for Elijah Advocates and Soft Drinks Dealers in the first 2 years of operation, showing clearly the balance brought forward at the beginning of the second year. So as we have said, again, with this one we shall have a column for details, year 1, year 2. Our balance brought forward. The first period they did not give us any balance brought forward, so we shall not record anything. Then cash inflows, we have the capital, which was 50M, bank loan 70 millions, income from sales, I think that is obvious. We're getting money from what we have sold, so it's an inflow 3,276,000. Then we add them up to come to 447,600,000. Our cash outflows include interest on loan. So how do you get this interest on loan? Here, you're going to get 16% of the loan that you are given. And then we shall come to 11,200,000 in the first year. So in the second year, how do we get the interest on loan? That means we are going to get the amount minus 14M. Then what we shall be left with, because that is the loan payment, I think you're seeing it below, because they told us loan payment is to be paid in a duration of 5 years. So we got 70M divided by 5, we come 14, and that's why we wrote loan payment 14M, 14M. So the interest for the second year is 16 over 100 times 70 million minus the 14 that we have cleared in the year 1, and then we shall come to 896. I think in these first 2 years you can see it's reducing. In the first year we paid a lot, 11,200,000. Second year 8,960,000. So as the years go by, it will keep on reducing. That's what we call as diminishing balance method or reducing balance method. Then they gave us fixed costs. As you hear, we're spending money on some fixed costs, which is 36. You copy it as it is given, put it there. Variable costs, the same case, it's an outflow, you do the needful. And then you sum them up and you come to 318,333,500. Then how do you get your net cash position? As we said in the first example, we shall get our total cash inflows minus the total cash outflows. And then we come to 129,266,500, which we shall carry and consider as our balance brought forward in year 2. So you do the same, you add them up, you cash outflows, and you get the difference 456,866,500 minus 317,350,300. Then you come to 139,516,200 as your net cash position. So if you ask what is the position of your business, I say again here, this business has a net surplus. Our inflows are exceeding our outflows. Hope everything is clear. So let's continue. Now we come to the indirect method. The first examples we are looking at direct method. Now indirect method, cash flow from operations. We're going to adjust the net income on the period outflow to cash basis. So increase in assets. An increase in assets shows that cash was spent, so that is a cash outflow. Should note that when assets increase, assume they tell you motor van 100,000 in year 1, motor van in year 2 200,000. So you can see there is an increase. We shall get 200 minus 100, which is 100,000. So an increase in our assets, it's a cash outflow. As you hear increase in assets, we are buying more assets. So money is going out, we shall post them under cash outflow. Then decrease in assets shows that is a cash inflow. How? We are selling some of our assets. Maybe you sell your car, maybe you sell your house, so you're getting money. That is a decrease in your assets. We come to the liabilities and the shareholders' equity. Increase in liabilities, cash savings. So that is an inflow. Increase in liability is an inflow. You get more debts, money is coming in, so it's a cash inflow. And the opposite, decrease in liabilities, it's a cash outflow. So paying back debts to spending money, that is a decrease in your debts. Then shareholders' equity, again we are saying increase in SHE. SHE stands for shareholders' equity, means it's a cash inflow. If our capital increases, then it's an inflow. And if the capital decreases, then it's an outflow. When you master this, then it is going to be easy for you to prepare a cash flow statement using an indirect method. Another thing I want you to note, whenever we're preparing cash flow statement, we always consider the cash balance for the first column or first year as our balance brought forward. There is a cash or bank. So if they give us cash and bank, we shall sum the totals for the first column or for the first year or for the first month, and when we are posting it, it is considered as our balance brought forward. Take note of that. So we're saying indirect versus direct method. Companies favor the indirect method for two reasons. It is easier and less costly to prepare, and it focuses on the difference between the net income and the net cash flow from operating activities. So you'll see if you have to check magazines, some publications, newspapers, you find most companies prefer using the indirect method. Reason being, we have mentioned them there. So let's look at the second example using the indirect method. They have given us assets and liabilities. In 2018, these were the figures, and 2019, those were the figures. I'll attempt like two from each category. Machinery, 5 millions in 2018, 12,500,000 in 2019. So as you can see, machinery is an asset to our business, and we said an increase in assets, it's a cash outflow. We are spending money to buy these assets. So here what we shall get 12,500,000 minus 5 millions. It's what we are going to post. The amount that is left is what we are going to post. We shall write machinery, I think it is 7,500,000, okay, as our cash outflow. Then I can skip motor van, it's the same as the one we have just looked at. Stock, look at stock, 600,000, 200,000. So stock is also an asset, but in 2018 we got 600,000. In 2019 there was a decrease. So we say the decrease in assets is the cash inflow. So stock, we are going to post it under our cash inflows, and we shall get the difference, 600 minus 200, which is 400. So under your cash inflows, you just write stock 400,000. We come to the liabilities. I also attempt two. We have loan, 2,870,000, and then 2019, 2,350,000. So we are seeing there is a decrease. A decrease in loan, it's a cash outflow. We are spending money to clear off our debts. So we'll get the difference of this 2,870 minus 230, and that's what you record and write loan under your cash outflow. Let me look at creditors. Creditors, I think you're seeing is 2.5, and there it is 7 million. So there is an increase in the creditors, and these are liabilities. So an increase in liabilities, we said that is an inflow. So with that, again, you get the difference, 2.5 minus 7, which is, I think, The amount that you get is what we call direct creditors. I think it's 4.5. Then you post it there. So with the indirect method, as I repeat, I told you to look at the amount cash. The cash. Let me also talk about cash. I told you cash 800,000 under assets. That amount is considered as our balance brought forward. So if they give us cash and bank, we are going to sum them, both of them, 800 plus 2,500,000, and then we consider it as our balance brought forward. Then someone else would ask, then where are we going to post the 1,003,000 in year 2019? That one will come as our net cash position. So if you post everything right, you will come to 1 million plus 3 million, which is 4 million as your net cash position. I think you've taken note of that. Then the rest are clear. Give it a try and see where you come to what. I think that is the end of our presentation. Thank you for watching and hope you enjoyed. See you next time.